The investor landscape has dramatically changed in CPG over the last few years. Megastars like Poppi, Siete, and Celsius had major exits, while at the same time, I talk to dozens of brands every single week who are going under after not being able to raise another funding round. So, what are you to do as a CPG brand? Whether you're starting out or if you've raised a round before, where do you go from here? So for this conversation, I have invited on both the investor perspective and someone with the founder whose exit perspective. We have Eric Stief, who is the principal at RCV Frontline, which is a fund that invests in food and beverage and food technology companies at seed and Series A stage when they are typically in the $1 to $5 million annual revenue run rate range. And Veronica Lehman, who is the founder of Pure Organic, which was acquired by Kashi Company in March of 2016. And now she spends her time helping other founders grow and their businesses strategically. Eric and Veronica, welcome to the show today.
Pleasure to be here, Jordan.
So, Eric, I'd love to start with you. Give us a sense of what the investor landscape is looking like for CPG brands. And just to timestamp this, we are in May of 2025. We're in the midst of tariffs that are going on up and down every single day. There's big changes that are happening just in terms of the supply chain round. So what are things looking like from your perspective and what you're hearing from other investors?
Sure. Yeah. So great question. So yeah, definitely the landscape has changed, and I'll give a shout out to a friend and colleague, Ryan Williams, who has a group called The Fabid that has a great report on this. But I'll steal a little bit of his information, which we're all feeling anyway. Definitely, if I'm gonna put a bow on it, the current deals there's less of them by certainly a dramatic shift downward, but then larger deals. So that's meaning it's both skewing lower and also the later stage companies, maybe we'll call it B, C stage versus the seed A stage, are getting the funds. So less deals, larger size of deals is certainly what we've seen when we look at the numbers recently.
And from that perspective, then, are you seeing still the same amount of like companies who are pitching to you, or have you kind of taken a step back and said like, hey, we're just not even going to have conversations with those early stage companies because we're not sure, there's no path to investment? Or are you still out there actively looking for maybe the really good deals out of that?
Oh yeah, we're still active. So if you're talking about traditional venture capital funds, which RCV Frontline is one of those, we have a certain time horizon. Just broadly speaking, the first 5 or so years of a 10-year fund, you're making those investments, and the second 5 or so years, you're seeing the exits, and we're right there. FYI, right in the middle there. We're at year 5 with our fund right now. A couple investments to make, and a lot of other funds are in the same shoes as us. So we absolutely need to be looking at these deals because we need to deploy our capital because that's our mission. So we want to be smart about it, and we're certainly being more selective and looking at valuations and preferences and things like that as part of the deals. But we are definitely still actively looking, just more selectively. We have to be.
Veronica, when you started your company a number of years ago now, what was the investment landscape like then? Did you start off with an investment and going after kind of money and finding that? What was that landscape like?
I feel like it's always been tough. Even a decade ago, there's just a lot of competition. There's a lot of companies. There's a lot of innovation. So I empathize with the stress that, these small and mid brands are feeling right now with trying to scramble after funding. Started by being self-funded, but it was really important for me to not put my family in debt. And so within a couple of years, I was really actively looking for a cash infusion. And I was willing to be creative with that initial partnership with investors. And I did end up making a really probably atypical partnership with a venture capital group. But it served me really well and allowed me then to kind of sit back and focus on growing the business, knowing that the business was funded, and really think about, where we could take it.
As I think back to my experience, I launched my CPG brand T Squares back in 2015. And pretty early on, we took our first investment. I think we were probably 3 months into the business, had maybe done $10,000 in sales and raised $100,000 from the early stage VC, right? And like that was a time where a lot of investors had just raised funds. They were looking to deploy capital. In fact, I think I met our investment group before they even closed their fund or even started raising or getting deposits from doing calls for their fund, right? Like it was at that peak time when there's a lot of investment in early stage CPG brands. And it also set me up on a course that as a new founder, I don't think I fully understood in terms of what investors are looking for because I thought like, oh, great, like now we can have some money. So I'm not just putting my own savings in and seeing my bank account going down, but I didn't have the vision or experience to forecast like what that meant for the direction of the company and how we had to build a company. And so, Eric, I would love for you to kind of share from the investor perspective what does making an investment in a company look like in terms of where you get the funding from to make that investment, and then what are those expectations?
Sure. Okay, that's great because it is important to kind of know the customer, if you will, for the brand, so to speak. So as a fund, we have raised our money from limited partners, LPs, and they put their capital into our fund and invested in us with the idea we're going to invest their money in this space that we've defined with the thesis that we have. And over the course of the 10 to 12 years that the fund has to deploy that money and then exit from those investments, return the capital to them. So why that's important is we do have a pretty strict timeline for how we need to go about this. And at later stages of the fund, as I had mentioned before, I'm in year 5 of my fund, I look at what I call less green bananas. And by that, I mean I look at things that have more risk or less risky, rather, de-risked, have more proof of concept, have more sales history and demonstration. So over the course, earlier on in our fund, we were investing in more early stage things typically. And then as we have moved along, we're looking at later stage things. And most funds would probably follow a similar path.
Yeah, that makes a lot of sense. And when your fund raises money, essentially you raise a certain amount and then you have a certain amount of time to actually deploy those funds. Is that right? Like, what does that window look like?
That's correct. Yeah. So broadly speaking, so let's say we have a 10-year fund and the first 5 or so years is when we're planting the seeds or, seeking our investments, doing our investments, making our bets. And then we'll reserve some capital for follow-ons in those investments as well. And then as we cross over to that next stage, that's when we start to harvest, right? And we'll start to see hopefully successful exits from the investments that we made. So they'll be acquired by strategics, private equity, roll-ups, things of that nature, and we'll be able to get our capital back out. So that's broadly how the timeline looks.
And Eric, it kind of just struck me a little bit because I know we're recording this in 2025. There's a huge amount of, I think, capital liquidity stock market kind of raised post kind of the crash from the pandemic. I think a lot of companies, a lot of people put money into funds. Are we just seeing that natural cycle where now we're in the 4 or 5 years after funds were raised, and so there's just that more mature later stage fund cycle versus there being fewer funds started or raising new funds in the last year that have more capital to deploy?
Well, I mean, we didn't all start at the same time. So there is going to be a smoothing of different funds that are starting all the time. But what we have seen we saw a slowdown and because we saw that, we saw a slowdown in that capability for, say, the other thing is after you're a certain time in your fund, you start to raise your next fund too, right? So, as funds haven't been able to talk about as many exits yet because exits are taking longer, they haven't been able to as often raise the new funds. So because of that, there has been a bit of a slowing in new funds coming to market that are looking for those earlier stage deals.
Okay. And Veronica, after you decided to take on investors, how did that change how you had to think about the direction and timeline for the business?
Yeah. Again, taking on investors, it really opens a lot of doors, but it also kind of forces you to grow within a framework. And that framework is all around, kind of the strategic plan for the business. To Eric's point, there's a timeline, there's a margin expectation. And so I do think it's really important for brands as they're thinking about taking on money and then some obligations that are tied to that money to really understand and try to kind of articulate what their long-term growth plan is. Because if you're, if you're growing to exit, it can potentially be a very different margin strategy, and it can be a very different innovation strategy than if you're growing to build, to build a brand, to build an empire, to build whatever it is. You're growing to grow and to build share and to, take share in categories and worry about exiting later. It's a very different strategy on a lot of. So, for me personally, I did feel the pressure, the margin pressure, the innovation pressure. And in some ways, it opened doors for us financially and eventually to an exit. But in other ways, I feel like we were constrained, especially on the margin end, because we didn't, take risks or sell in places or sell products we knew were winners because they were low margin and we didn't want it to drag our margin down. So there's a
Yeah,
lot
talk
of.
a little bit more about that. Like in that need to have a higher margin, was that driven by kind of strategy from the investors, looking at what acquirers would want? How do you think about that?
Yeah, I mean, I think when you're talking about these, strategics and large investment companies, it's kind of like a resume, right? It's like, I feel like, there's the sense of there's a lot of people competing for this money. There's a lot of companies competing for the money. And so the first go through of all the resumes is like, who just kind of meets the standards, right? And then there's maybe like a deeper dive. And so I think for these companies, you're thinking, I really need to be kind of here with my margin and here with my growth and, kind of meet these standards, which I think is, there's truth behind that for sure, because you want to catch their attention. Like, okay, this is a healthy company. Plus they're doing all these really cool things and they've got these great products. So, that is constraining. If you didn't have that pressure, you might have an opportunity with a low margin product to get into club and to really, cash infuse your business. Club is risky and then it drags your whole margin down. And so you just end up, I think, making different choices when you're a little more constrained by the investors and people who have a say in your business. But that's not to say that, it's also a great stepping stone, and taking on investors definitely opens doors and possibilities and is what led us to our exit. So just a lot to think about for this, your specific business.
Yeah, I think one thing I always remind founders is that once you take on an investor or any co-founder, equity partner in your business, that's usually a relationship that will stay until the end of the business for the most part. I've seen probably very few situations where an equity partner leaves and you actually can get back that equity in some form. If anything, it might be transferred to someone else who takes their spot. That gets pricey. So it's really important to make those decisions with eyes wide open in terms of what that means for your business, which is why I have our webinars and things like this to make it really clear to founders kind of what that future would be. I mean, even just from my experience with T-Squares, we had great investors as well, but also set us up on this path where we knew we had to grow in a certain timeline, a certain speed. Because we had the cash, we felt like we needed to spend the cash to grow the business. But quite frankly, we had yet to achieve product market fit with the products. And so realistically, we actually saw our bank account dwindling and going down every single month because of the cash flow situation and the realities of selling in retail, and how much money, like cash, you're actually getting into the business. And it caused a lot of anxieties. I know of having expectations from money that we got from investors, knowing we needed to return it, but also seeing our cash in our bank going down. And I think after kind of years of seeing that, it added some anxiety and pressure on that, knowing that there are other people whose money you were investing. I'm kind of curious, like, Veronica, did you have any sense of that, like responsibility and that kind of a weight, like good and bad, to like perform?
Oh, completely. Yeah. I mean, we had board meetings every quarter and it was all about the numbers for sure, and all about the margin and not seeing that margin slip and seeing those numbers grow and, looking at our velocities. And I think now more than ever, investors are really looking for solid foundations, not just high velocities, but where are how are those velocities happening? Are they spending to get the velocities? Because that's different than if, the velocities are happening more organically. So I think, and I'm sure Eric can speak more to this, but for startup and mid companies, really growing a healthy foundation, having a really good retail strategy. So you're not just taking whatever opportunity comes your way, but you're growing into retail in a strategic way so that you can win and not get discontinued. That might take longer, but it will give you a foundation that I feel is more important in the investing environment today than it ever has been.
Eric, I am kind of curious on that because probably feel like 98% of every CPG founder I talk with wants to raise VC money. But what actually makes a company a good fit for those like a VC investment? Every company, like, should every company get that investment, or are there certain criteria, at least from your perspective, that you're looking for that you see leads to success with that investment?
Well, I mean, yeah. So off the bat, if they don't have a plan to exit that business, if it's going to be something that they want to hold on to, pass along, I mean, there's nothing wrong with that. It's going to be amazing businesses that can even be multi-generational. But unless there's a way for us to, as I might have mentioned, we walk in the door backwards looking for the way out. Unless there's a way to see, unless we're all aligned with the plan to grow and exit this, that's, they shouldn't look for venture money. Now, angel money, that can be different, and that's more patient. And, you can be like with those early days when you're just starting to focus on those early consumers and showing that core, those early wins before you have to grow like crazy to get to that size that you need to exit. Those can be things that maybe the brands that are looking for investment would think about too, versus the dyed-in-the-wool venture capital that has these rigid criteria. Some family offices might not have those criteria. They're playing with their own money, but we do. So that's something that we think about. Definitely is, are we aligned? And there's nothing wrong with not being aligned, but it wouldn't be a fit with us.
And then I'm kind of curious, what are you looking for from founders or for companies to make them good candidates for investment? Because I know a lot of people are listening, they're like, okay, I need money for my company to do X, Y, and Z. What are you looking for in terms of the size of the company, the founder, the product, kind of how are you evaluating what makes a good investment?
Yeah. And so great question. And as our fund goes further down its timeline, this has shifted a little bit with us. But I mean, we always did have revenue targets for the companies that, that's a good way of showing some initial proof of concept. And early on, as you mentioned before, we were looking at companies in the $1 million range, 1 to 2 million. As we've moved the fund along, more often we're looking for things 5 to 10 or over 10 in some cases, or even some secondaries like you had mentioned before, where things are getting a little bit de-risked. Margins, gross margins, if I see them south of the fees, say I get eyebrows raised, why is that? Those sort of things. Velocities, are they beating their core set? And to Veronica's point as well, you're not just getting that velocity uptick because you spent and saw velocity go up just because you had some promotion. Is it sticky? And so we're seeing, can we demonstrate stickiness of velocity? So those are some of those financial hurdles that we take a fairly close look at. We're operations focused. I'm a food engineer by education. We're part JPG resources. Some of us are also day to day with that. So we're very operations focused. So I look at co-man agreements. I look at a criteria like, do you have, are your labels looking correct? Things like that, for some of these early stage companies. And then as far as the founders go, I mean, we love to see seasoned founders that have had successes in the past. Who wouldn't? If they don't have that street cred, if you will, then what do they have that makes them special? And also, are they coachable? That's just as important. We try to be value added and provide advice as we can from having made every mistake once and fixed it twice, as I like to say. But sometimes founders will be open to that and sometimes they won't. So coachability is key.
Eric, can you think back to either one of the last investments that the fund made, or even just a really great conversation that maybe like you wish you could have invested if the market was different or something? And think back to like what stood out about that experience going, like meeting the founder, their follow-up, presentation, due diligence. What kind of attributes stand out in terms of what made that process so easy to say yes to?
So in one case where we made an investment recently, a team of two solid professionals that knew their lane. One was very technically focused, one more on the sales and marketing side, but also clearly had the capability to debate each other, not being a yes person to one or the other, and have meaningful conversations. So the leadership was there, and they were also very coachable, and wanted to would follow up on our advice and actually come back with answers in a timely manner for the questions that we did have. And then also just having a very unique product that even had some intellectual property around it, which is difficult to find in food and beverage just because it's food and beverage, not pharmaceuticals or something like that. But technology-based intellectual property was also key in that case, which is what we liked.
No, I think that's great. I think back to one of my early investor meetings with a angel group, and I knew nothing about kind of talking with investors, what they're really looking for. We had an initial pitch that I think went well, and then they asked like, "Hey, can you share some of the metrics around your business and how things are going?" And I sent over essentially our internal sales tracking for our like Whole Foods account. And it was organized month by month for like each individual store over maybe a 6 month period. We had just launched in Whole Foods in Chicago. And I remember sitting down in that meeting and thinking like, oh great, like I just like share everything. They can look and see how our numbers are. Like that's great. But it was actually a little overwhelming where they're looking and say, hey, I see that in the Hyde Park store in September, your sales were like zero. What happened there? It's like, oh, well, the buyer was actually sick for 3 weeks and so couldn't come in to make the order. And they're like, okay, okay. Now, what happened in this kind of account? And I realized, right, like because I gave them just all the information, they got to make up whatever story that they wanted about our information without having any of the other context that went on, the nuance of running a business. And one thing that I realized was like, yes, the investor wants to see the actual metrics and they should all be true. But from a founder perspective, you also have to think about what's the story that you want to show through your numbers and like where the business is going. There's always going to be some parts of your business that are maybe not doing as well and you cut those out or improve them. And there are others that are going to be doing really well. And then there's a composite together and each of those stories is a little different, although they're all true. And so I kind of learned how to share and understand not just like where we are, but where we're going and really kind of share that story without giving every single data point without any of the context. Like I'm wondering, because I know you went through the acquisition process and had investors, what you kind of learned about using your data to tell the story of the brand without just giving every single data point.
Yeah, I mean, I think it's important to remember that you're not just selling what you've done, but you're really selling your potential. And that's, I think, a huge part of an acquisition for the larger companies for sure. They want to obviously see a good track record, but getting in front of all of those big strategic companies, it was all about where can we bring this brand? Here's what we've done. And so having a really strong brand presence, having a really strong vision for your future, for your innovation, for categories that you want to enter into and know that you could play well in, and being able to tell that future forward story, I think is just as important as, the backstory and the data points. And yeah, I mean, I think, data, you definitely want to use it to your advantage, and if they're good, they're going to do their due diligence, but, you don't have to put everything in front of them for sure. You just want to tell a good story and show like at a high level what your brand's done, but then really have great brand equity and a great vision for where your brand can go. And I know that had a lot to do with our acquisition as well.
I think about it when you have those super detailed spreadsheets that have all this information in there, that's a really good opportunity for you to say, let's go over this together versus give some more high level stuff at first so we can get our arms around what you look like, basically, but then ask to go through the detailed stuff together. And with these online, Microsoft Teams and whatnot that we have now, it's so much easier. You don't even have to be in the same room. You can walk through a spreadsheet together. It shows it's a way for you to bond with the investor, show your capabilities, your intellect, and get their buy-in as you're going through something. It's an opportunity to sell, if you will.
Yeah, and build that relationship. I'm kind of curious too. We've seen, as I mentioned at the top, like a lot of breakout brands like Poppi, Siete, Celsius have acquisitions. Do you think that's starting to put more excitement or fuel into funds to be able to raise more money again and put more fuel out there and make those investments? Have you seen any kind of change even just in the morale, I think, of the industry since there?
Well, yeah, I can say, knowing a little bit of who invested where, some groups that were investing in funds like, or in brands like those, are probably having better luck raising that next fund, and so they're able to show that as Exhibit A, right? And those are great examples. And also, looking back, why were they successful, right? Strong balance sheets in pretty big categories, and excellent products. So yeah, though they are building excitement, but there's reasons why they got there.
Yeah. And then, Veronica, I'm curious if you've just in talking with founders in terms of and seeing like, is there have been like excitement there or founders kind of more pumped up? Because I honestly talked to a lot of founders who are fairly de-energized, I think, from the industry because they're like, nothing's happening. There's no investments. There's no exits. Where's this even going for me?
I think the attitude is still nervousness a little bit. I think there will be trickle down from these larger acquisitions, but it takes a while, right? And so I think there's a lot of smaller and mid-sized brands are still feeling the squeeze. They're still really hunting for money. They're still trying to understand how they can move forward if they don't have that investment money and the best strategy to take. But I think the good news is we are seeing the change happen, but I think it's going to be a little bit of a trickle down effect, and then that's going to take time to really get excitement built back up in investing and money that's available for these smaller companies.
Yeah, those that are new entrants that don't have previous funding where the investors want to follow on, breaking in is tough, I can imagine.
Yeah, I'm wondering your perspective. I think I've taken a fairly, like, I'm an entrepreneur, like, I love founders, but I've also taken a fairly, I don't want to say like harsh, but maybe realistic view of saying that like if you're launching a new company now, you should either come in it with, I call it 3 C's, like cash, either yourself or from investors that you have relationships with, customer demand, where there's a huge want for a product like yours that's not being fulfilled, or an audience of companies. There's a lot of influencers, celebrities have kind of built audiences that trust their brand. And if they have something to sell, they might be able to sell hundreds of thousands or millions of dollars in product just from their community that they built before, of really having that leg up to get started. I think a lot of founders who just come in with an idea and none of those are having a really challenging time just even getting off the ground. And I'm kind of curious if you've seen something similar, like you have to have something in these days because there's not that free seed money out there as much anymore. So you have to come with your own resources.
Oh yeah, the ones that are successfully getting to the spot that we can actually make a decision on to invest, they've had previous funding, friends and family or something like that, where they're able to have that incubation period or whatever you want to call it, where they're proving their concept, that they're demonstrating some early success in a focused region, maybe focused store set, focused consumer demographic, whatever it is. And with direct to consumer, that even becomes more of a compelling strategy. And so they're able to prove it out, and they're doing it with more patient money. Because if you think about it, even if they're $1 million brand and they double every year by like year 7, what are they, $64 million? So they need time to get to that magic number that then we can pour the gas on, because they've showed it can work, and we can wash, rinse, repeat, or whatever we want to say, with extra capital. and then get to that growth trajectory that we need to see so that we can get to an exit.
I'm curious if you have any thoughts on the brands who maybe raised a round of funding, but know they need to get to a second one because their cash is running out, and they're thinking, all right, do I continuing to pump money into maybe paid media or take on lots of new opportunities to show growth, knowing that it's going to stress my cash flow? Or do I focus on profitability, which usually means saying no to some of those high risk categories, maybe a slower growth trajectory in the short term, but it might not look as opportunistic for investors?
It's a tough one, right? I mean, so do we want profitability or do we want growth? Yes, we want both, right? And I know that's a tough thing to say. Brands that are sub $10 million, it's kind of hard. Some would say borderline unrealistic for them to be very profitable, if at all. But they've got to get to a certain mass and be able to grow from that. But so they got to have capital to ride through the rough patches. They've got to I would say, at the very least, be able to demonstrate that they're being very lean and scrappy in what they are spending money on, being as, the best bang for the buck that they can get with that promotional spend, not going crazy on headcount, for example, trying to be lean everywhere you can so that you can modulate, because it will almost certainly take longer to raise that next round of funds than you're expecting it to, based on what we're seeing these days.
Veronica, I'm kind of curious your thoughts too around that. Have you seen companies change their mindset strategically in terms of maybe focusing on the business fundamentals and growth and trying to
Yeah.
get to profitability over seeking out investors to fund the company?
Yeah, I mean, I think there's definitely a learning curve with a lot of founders, especially if you've been funded and now you're kind of starting to run dry again, that they do start to focus more on the fundamentals, but just learning, have good strategy and to spend as close to their consumer as possible, because they want to create success stories in retail that they can then take to the next retailer and build that, kind of foundational retail success. They want to keep building their brand, but I think the social spending and influencer spending is secondary to spending to get your consumer at the shelf noticing your product. And so I think that's a transition we see in a lot of founders, because the social spending is, really sexy and they want to see their brand go viral. But really it's the spending at the shelf, and it's getting the shopper who's right there ready to spend money to notice and buy your product. That's the way you should be spending money first, and then additional money later. But yeah, that
Yeah.
definitely that switch in mindset happens with a lot of businesses and founders.
Yeah, I just saw a post yesterday from Megan Thiemann, who's the co-founder of No Baked, which is a cookie dough company, and her husband Jimmy had scoop shops for a while, like retail stores. They expanded into CPG products, or really trying to grow that business. I know they were raising a funding round. They tried doing an equity funding round. And she just had the posters like, hey, we're in the middle of another pivot. And they're like, it's more about kind of aligning with their own happiness. And, to quote her LinkedIn post, we spent so many years absolutely miserable working our lives away to try to grow as quickly in CPG as we could. And this was being bootstrapped. And then they, asked each other, why don't we just focus on building a, sustainable business? And I do see this shift towards a lot of founders now, and their mindset being, look, growth at all costs is not as sustainable, and how can I build maybe a business? And that recognition that not every business is designed at its core to be a high growth business that's even right for VC. And so I'm all for the right sizing. Earlier, I mentioned that most founders at least try to seek out VC. I would even, and I don't know if this cuts off some of your supply, but I would love to see 10% of companies maybe see VC as the right opportunity for funding right now instead of 98%. And those 10% are the ones that have the foundation, they have a proven product in the market, and those funds are used to grow their company in a relatively proven way, versus it being so speculative that most of those bets, fail. And I would love to see more companies have that mindset. And then I think more companies will ultimately succeed if they know they have to prove out that demand on their own, or, using their own funds and funded by customers.
Yeah. That I agree. Having that foundation and proving it, and then coming to us when you have that proven model that we can help you scale. That's great. I love it. I think as explorers ourselves, we'll probably always still want to find some of those really interesting, cool things that might be early days. But absolutely, I like the idea of having it proved out, and also it helps the founders to appreciate what it is to run that business, and get, if they're using a contract manufacturer or they're manufacturing themselves, iron out some of the kinks there as well first.
Eric, any final thoughts on for brands that you've learned from your experience as an investor and knowing operations that founders should really be thinking about to set themselves up for success with their business right now?
Yeah, well, I mean, as they're seeking to attract capital, I mean, certainly expect it to take longer than what has in the past, because we are all being very careful with our money. Target the funds that are in your wheelhouse, meaning funds that are investing in your space at your stage. Typically, funds will do a pretty good job of explaining what their criteria are on their website. So be educated about what's important to them. Look at their portfolio before. Maybe they'll have something that's similar to you, that maybe that's a good thing, maybe that's a bad thing, or you'll be able to you'll know a founder at one of their portfolio companies, and you can reach out and get some inside baseball on them to be well prepared. Don't be greedy on valuation. Right now, valuations are quickly a great way to get to know, to get to NO on something when we're trying to screen all these deals. You can do a lot with a small, clever, lean team, and we definitely now more than ever want to see frugality,
Yeah, that makes a
intelligent
lot of sense.
frugality.
Veronica, any final thoughts from you for founders?
I mean, I would just say, reiterate, understand your long-term plan and what your goal is. Is your goal to make a living? Is your goal to invest and then exit? Where do you want to see yourself in 5 years? And also grow, to give yourself some options as you grow and as you develop that business.
I think that's key. I think that's so important. And, just from my own experience, when I launched T Squares, our plan was to grow and sell in 5 years as our first business. And things did not go on that path, and we ended up shutting down. The new work that I'm doing through Food Bevy and my other company, Joyful Co., I had a much longer term vision, saying, hey, I want to be able to run these for 20, 25 years. And as a prerequisite, we need to be profitable in our first year, right? And so in
Yeah,
setting those constraints, it both
totally
allowed
different.
us to build the foundation to have that
Yeah.
strong business now, and then that I could continue to run and grow and achieve that mission kind of down the line. I don't think I probably would have gotten here without having gone through the experience with T Squares and having to grow and shut that down. But I always want to give founders the confidence that whatever business you want to build for yourself, like make sure that's front and center, whether it's high growth or if it's a business that you can build a great lifestyle from. And I want to put more positivity back into the lifestyle business, and say that that's a really great thing to have, and
Nothing wrong with that.
want to success that. Perfect. Well, Eric, Veronica, thanks so much for joining me today.
It's an honor. Thank
Thanks,
you.
Jordan. It's been a pleasure.
Of course. And just want to give a shout out as well. If any brand's looking and they're trying to understand the decisions with their business, whether on the investing side or getting your operations done, definitely check out JPG. They also have a cohort program that works with emerging brands to help you grow your company by matching you with other students and trusted mentors to grow your business. We'll include a link in the show notes as well. It's just really great to have a community to be able to support your business as it's growing. So definitely check that out.